Let me get more on the markets with our next guest. He's a strategist or chief investment strategist at Janney Montgomery Scott. He's Mark Luschini. Mark, thanks so much for joining us this morning. And we were just talking with Todd Horowitz at the CME, and he's got a real trader's point of view. Obviously, he says, look, it seems as if we're going to be range bound here for a moment in time. The volume is not picking up. But what is going to be the catalyst? Is it earnings this time around to get this market out of the funk?
Well, we've been speculating that, in fact, it may just be that it will take corporate earnings to spark investor enthusiasm for equities, because we believe earnings are in balance are going to be pretty good, and we think that the forward-looking statements that are going to accompany those earnings announcements relative to management's forward-looking statements ought to be encouraging, that we're going to see some improvement in economic activity in the second half of this year. And on the back of that, corporate profits should remain reasonably decent, and as a result, with equity valuations at about 12.5 to 13 times those 2011 earnings, we think valuations are undemanding. And given the fact that alternatives like money markets and even fixed income securities offer little in the way of return, in fact, in some cases, return-free risk, we would think that would be a very inviting scenario for equities.
Okay, but the thing is that the equities have not done anything so far. I mean, it's been sort of back and forth in a trading range. So what in the earnings so far is telling you that this is actually going to happen?
Well, we are very early in the season, obviously. We've only had a couple of companies, Alcoa, obviously JP Morgan announced, Citigroup announced earnings much better than expected. But I think it's telling that so far, at least, we're not getting any kind of earnings disappointments. And the confession season leading up to earnings season was very light on that front, which suggests that companies are likely to meet or exceed expectations. I think the market's been jostled largely by the amount of macro issues that it's been dealing with in the absence of any real corporate news. So with corporate earnings season getting underway, so far so good on that front. M&A activity, announcements like today, Carl Icahn, a smart investor, saying that he would like to acquire all of Clorox, I think is indicative of the appetite for investors who are willing to participate in risk assets, saying valuations look pretty appealing.
Mark, were you disappointed at all that Bernanke was on the whole neutral for the market this week?
Well, it's interesting. We assigned a very low probability to the announcement of a QE3, primarily because we thought the hurdle rate for the resumption of some type of asset purchase program was very high. Although recently, the last couple of months of jobs data would be indicative of enough weakening that I think would certainly spur the Fed to act at some point in the not too distant future. But yeah, I think the market basically melted up on the back of the hint of QE3, and subsequently yesterday took back some of that. So, net, we weren't disappointed because we weren't really expecting to see any really, robust announcement coming out with regard to an asset purchase program. I think the Fed's going to remain highly data dependent for some months to come before it decides to do that.
Right. For now, no Fed-induced equity market rally for the
I think not.
For the second half of the year. What about, though, a sell-off on the back of this debt package in Washington? Are we prepared for that? What do you think?
Well, it's interesting. I heard earlier on your program something that I would tend to agree with, and that is, this is not new news. In fact, we're 18 days and counting, and yet the equity markets are trending higher, at least today. The debt market certainly hasn't become untethered relative to, a 2.95 or so 10-year Treasury bond yield. If the markets were sniffing out an Armageddon scenario to come from the lack of some kind of resolution to the debt ceiling, I think it would have started to bake some of that in at this juncture. I think obviously that as we draw a little closer and we don't have some resolution, even if it's something that's largely unsatisfactory to both sides of the aisle, that might, I think, institute a little more volatility in the markets. But at this point in time, I think that us, along with other market participants, are of the belief that some accord will be put into place before we reach that deadline, and the markets will continue to focus on the other issues, which are not inconsequential, certainly, as it relates to Europe. The larger fiscal situation here in the U.S. Are two that are playing, continued havoc with the equity markets, and will likely continue to do so, obviously, for some time.
For some time, indeed. Mark Luschini, thank you very much. Appreciate you joining us.
Thank you, Betty.